So thanks all for joining the call. I'm Nicola Glass, Independent Financial Advisor for Integrity 365, and today we have Steve McPhillips, Technical Sales Director from Dentons Pensions. So thank you, Steve, very much for joining us today. So today we're going to talk a little bit about pensions. We're going to guide you through sort of some of the informative areas of tax and investable assets in a SIP and SAS. And then we're going to make some room for some questions at the end. So please do feel free to write in any questions at the end of the webinar, and we will take a little bit of time there to answer those. So now I'm going to hand you over to Steve. Thank you so much.
Thank you, Nicola, and good evening, everyone. Thanks for joining us, and thanks to Nicola and our colleagues for inviting us to participate in this evening's webinar. As Nicola said, I'm Steve McPhillips. I'm Dentons Technical Sales Director, and part of my role at Dentons is to provide technical help and support to financial advisors, their support staff, and to my colleagues in our sales and marketing team. And I've got colleagues around the country that deal with Nicola's colleagues around the country. I'll introduce you to them later on with our contact slide. I just need to make clear at the very start, though, that I'm not, and none of my colleagues in Dentons are authorised to provide you with regulated advice in relation to setting up a Dentons pension scheme or transferring any money into it. We can only give you factual information on what our products and what HMRC will allow within pension schemes without tax charges arising. And that's we're not authorised to give you that advice, but of course the advisor on Integrity 365 are the very people to go and speak to for that. So hopefully some of the information I'm going to give you, factual information tonight, is of interest. If you need advice around any of those matters, please do speak to Nicola or any of our colleagues. What I'll do now is I will share my screen so you can actually see the slides. Is that okay, Nicola? The full slides on the screen, yeah.
There we go. Yeah, all okay now. Thanks, Steve.
Okay, great. Always need to check that the technology is working in the background. So yes, we've called it Navigating a Course Through Self-Invested Pensions, and Nicola's already mentioned SIP, which is Self-Invested Personal Pension, and SAS, which stands for Small Self-Administered Scheme. They're quite close cousins of each other, but there are differences between the two, which I'm going to highlight during the course of the webinar. There's an agenda that we're going to follow. Briefly introduce you to Dentons for those of you who've not heard of us before, and then we'll focus in on the tax benefits of UK pension schemes, because SIP and SAS are typically UK registered pension schemes with significant tax advantages. Then we'll look at some different types of asset classes that can appear in pension schemes. We'll touch on commercial property. That's a popular investment across our client bank at Dentons. Commercial property being bought through a pension wrapper, and we'll look at some funding options about how you go about or can go about buying property through a scheme. And then we'll look at what happens in the event of your death and passing on pension wealth to your beneficiaries. One of the big tax advantages of pension schemes is that they're very tax efficient when it comes to death benefits typically. So we'll look at that as well. And we'll look at also what happens if there's no liquid cash in your pension scheme. Say it's all tied up in bricks and mortar at the time, unfortunately, you die or want to take benefits. We'll look at how we can potentially deal with liquidity. And as Nicola said, there'll be time for some questions at the end. So please do ask any questions through the Q&A functionality that you've got there. So very quick introduction to Dentons Pensions. We administer SIPs and SASs. That's all we do as a business. Nothing else distracts us. So we offer both a self-invested personal pension and we offer a small self-administered scheme. We look after over £7.6 billion worth of client assets across our SIP and SAS vehicles. We're based in Godalming in Surrey, although we've got a national presence around the country, as I mentioned earlier. And we've got a particular specialism within commercial properties being bought through SIP and SAS. We've got over 3,900 commercial properties that are owned by our clients through their pension schemes as at April 2024. So we are typically viewed as commercial property specialists. I'm not going to say any more about Dentons than that, because that's not really why you're listening in this afternoon, I'm sure. But if you do need any more information on Dentons, well, we can happily supply that via Nicola or any of our colleagues. Okay, so we said that we look at some tax advantages of pension schemes. And again, this is all factual information rather than advice. The government tries to encourage us to save privately for ourselves, for our retirements, and there's various ways that they try and give us that encouragement, and some of those are listed on the scheme there. So under current pension scheme rules, self-invested personal pensions or SSASs enjoy these considerable tax benefits, and if you make a personal or a member contribution into a SIPP or a SAS, you typically should receive tax relief on that contribution at whatever your marginal rate of tax is. But there are certain rules and limitations on how much you can pay into a pension scheme and have you receive tax relief on the contribution that you pay in. And that's one of those areas of advice that you'd speak to Integrity 365 about. Once money's in the pension scheme and it's invested, it's in a bank account or it's invested in some other assets, there's generally no income tax to pay on on the return on the investments that you get, and there's no capital gains tax to pay on any gain in the value of an investment that you make through the scheme. Say, for example, if you bought a commercial property and it doubled or trebled in value by the time you came to sell it, there's no capital gains tax to pay on that because it's one of the tax advantages of pension schemes. If your employer pays money into a pension scheme on your behalf, or if you are the employer, if you're on a limited company and you're paying in contributions as a company director, those should receive tax relief as a business expense through the company's profit and loss account. But again, there are rules and limitations about how much can be paid into a scheme in a tax relievable manner. And as I mentioned earlier, we're going to touch on some aspects of death benefits. Benefits payable from the pension scheme on death will normally be free of inheritance tax. There are one or two nuances around that, again, that you may want to speak to Integrity 365 about. And if you die before your 75th birthday, the benefits that are paid out to your nominated beneficiaries, we're going to come on to that, could be paid entirely free of tax depending on your circumstances. So all of those combined are the benefits that registered pension schemes confer upon scheme members, and that's part of the government's way of trying to encourage us all to save privately for our future, not rely on the state pension scheme in retirement. So if you've got a SIPP or a SAS and there's money in there, whether it's been new contributions being paid in or it's money you've transferred in from other pension arrangements, there are a range of different types of investment you can buy through the SIPP or SAS. And I'll put them all on the screen here so you can see them. But the types of investments you could buy, depending on your provider and what their product offers, are things like buying directly into the bricks and mortar of a commercial property. You might potentially buy shares, whether they're quoted shares or unquoted shares. Unquoted, by that I mean in a private limited company, not quoted on a stock market. You potentially could invest in gilt, so you could have your money deposited in cash, or potentially you could lend money to corporations in the UK or beyond. But this all depends on the provider, the provider's product proposition, and also what the only physical commodity you can buy through a pension scheme without tax charges arising is gold bullion, and then there are certain rules and regulations about what that gold bullion has to look like. So there's a range of different asset classes there potentially scheme members could invest in, depending on what the provider offers. We're going to spend a couple of minutes just looking at commercial property then as one of those, but we'll touch on some of these in turn over the next few minutes. We'll start with commercial property. And commercial property direct investment has various characteristics that people attribute to it. It's classed as what's called a real asset, and by that I mean commercial property its value tends to keep pace with or exceed inflation or RPI over periods of time. That might not always be the case. Investments can go up or down, as you probably know, but it tends to keep its value in line with inflation. Commercial property, bricks and mortar, or a portal steel frame building, an industrial unit, is tangible. You can touch and feel it. Your business may be able to operate from that, even though it's owned by the pension scheme. Commercial property is considered to be relatively stable compared to some other asset classes, like, for example, stocks and shares. Property values can go up and down, but typically it's considered to be relatively stable compared to some others. Hopefully there's a stable and possibly rising income stream from the property, because whoever the tenant is in that property needs to be paying rent for the privilege of occupying that property. So that rent comes into the pension scheme and then is available for investment in line with your advisor's recommendations. Generally a wide market for commercial property compared to some other asset classes. For example, unquoted shares in a private limited company, there's a very limited market for those. commercial property generally is relatively easily marketable. And it can be considered an illiquid investment. It may take some time to dispose of a commercial property or any other type of property, obviously. So generally considered you'd want a reasonably long marketing period in order to sell that property, if indeed you ever needed or wanted to sell it from the pension scheme. Some people would class direct property investment as diversification from some of the other asset classes that you can invest in, such as stocks and shares and some of the other things that we see. And the investment returns, it can be seen by some as a kind of halfway house in terms of risk and reward between cash and quoted stocks and shares or unquoted company shares. Why do people buy commercial property through a SIPP or a SSAS? Well, there's various reasons why our clients will go down this route. Different people have different motivations, obviously, different requirements. But the pension scheme is a separate legal entity from you as an individual or you, your company, if you run a limited company. And the pension scheme sits outside of your estate for inheritance tax purposes. All the income generally in fact, all of the income from commercial property comes into the pension scheme tax-free as cash into the pension scheme bank account, and you can then invest it in line with your advisor's recommendations, as I mentioned earlier. On eventual disposal of that property by the pension scheme, there's no capital gains tax to pay on the growth and value of it. As we said earlier, it's a tangible asset, hopefully a stable income stream. And your company or you as an individual could sell a commercial property that you own to the pension scheme. If that's what you wanted to do, you have to be supported by an open market valuation. But if you do that, then the pension scheme is effectively writing you a cheque for the open market value of that property, because you've sold bricks and mortar that you or your company own, and those bricks and mortar will now be owned by the pension scheme into the future. Some potential downsides to owning commercial property through a scheme: typically it tends to be a high value asset. That may be your one and only asset in the pension scheme, so that's something you might want to consider. Generally considered illiquid. And if you or your company are selling the property to the pension scheme, it may result in a capital gains tax liability at the point of disposal, or a corporation tax liability for your company at the point of disposal, sale of it to the pension scheme. There's a whole range of different types of commercial property that you can buy through SIPPs and SSASs. I've put some listed on the screen there. I'm not going to talk through them all. The properties that are generally straightforward are ones that don't have any residential element to them. If you've got a shop on a high street with a flat upstairs, that's where the complications arise, or say a pub or a hotel with manager's accommodation, because there's only very narrow circumstances where HMRC will allow a mixed-use property where there's residential and commercial, where they'll allow the residential part to be owned by the pension scheme as well as the commercial part without tax charges arising. So we've got to be very careful about any mixed-use residential and commercial property. Agricultural land, various other types of things are potentially possible investments. If you do have a commercial property in mind that you'd like to think about putting into a pension scheme, obviously speak to your advisor at Integrity 365, and he or she will guide you through the possibilities of that. When it comes to buying a property through a pension scheme, there's various ways and means of doing that. If there's enough money in the pension scheme to cover the purchase price plus all the costs of acquiring, that's fairly straightforward. The pension scheme can just afford to buy it outright. Or an alternative is that the pension scheme jointly buys the property with another party along with cash that it has. So joint purchase or part purchase of a property that you already own is a possibility. Again, this will depend on which provider that you're speaking to. And sometimes some of our clients will jointly buy a property, and the pension scheme is borrowing money to make that happen. There are rules and regulations about how much money pension schemes can borrow, but the other party that the pension scheme is buying the property with also is borrowing some money. So that's quite complex, kind of at the top end of complexity of the types of transactions that we see. But these are all potentially possible ways of, with money in your pension scheme and possibly borrowing some to make a property purchase happen. One of the other asset classes we looked at briefly at the start were equities. Again, equities are classed as a real asset, meaning that their value tends to keep pace with inflation over periods of time. Again, equities are tangible. You can touch and feel a share certificate. Equities can be seen to be more volatile than other asset classes compared to, for example, cash holdings or commercial property. The income stream may be variable depending on the company that you've acquired shares in. And if you've got quoted stocks and shares, ones that are quoted on a recognised stock exchange, they're readily marketable. If the pension scheme owns unquoted private limited company shares, there can be, and usually is, a very narrow restricted market for those. So these are things you've got to consider in terms of being able to sell those shares if and when you need or want to do that. Liquidity-wise, quoted shares are classed or determined as very liquid. Unquoted shares are pretty much illiquid because there's a very limited market for them. You've got to find a buyer for those private company shares that you own. Maybe seen as diversification from other asset classes as well. It's possible also through a pension scheme to lend money to companies. So we'll just look at that now. If it's a fixed rate that you're receiving for having loaned money to a company from your pension scheme, that would be classed as what's called a monetary asset, where potentially its value doesn't keep pace with inflation over a period of time. In terms of volatility and risk of that investment, it will vary with the strength of the borrower, the entity that you've loaned money to from your pension scheme, and any security that's in place. And in terms of income that's going to come into the pension scheme from having loaned money to a company, if it's a SSAS loan to a company, there are requirements around how that's got to look, and we'd be expecting to see at least quarterly capital and interest repayments by the borrower into the pension scheme. It can be annual, but no less frequent than annual repayments. When it's not a SSAS loan to an employer, the income stream will vary depending on the terms of the loan that you've entered into with the borrower. There generally is no limited or no secondary market, i.e. by that I mean, can you sell that loan onto another entity if you needed to turn it into cash? That can be difficult with loans to companies. And in terms of liquidity, generally it's not considered to be illiquid unless that loan is somehow repayable on demand by the pension scheme. And it'll also depend on any underlying security that the loan has there. But loans to companies in the SIP world, SIPs are allowed to lend money, but only to companies that have got no connection with the pension scheme whatsoever. Okay. So why do some of our clients invest in any of these asset classes that we've looked at before? Well, it may be for capital appreciation. It may be because the investment offers an attractive annual return. It may be that the investment the client chooses offers diversification, as we've said, from other investments that they hold within the pension scheme. And it also may just help clients to dovetail their own personal retirement planning with their company planning as well, because some of these investments that you can make within self-invested pensions do offer that opportunity to interact with your business along with your pension scheme. And it might just be because the investment that's available and that may be attractive to you is just an alternative to other mainstream type investments that you may be familiar with. Again, all of these will depend on your circumstances, and do speak to Integrity 365 about your circumstances for advice around them. Okay, some of the reasons why clients don't hold all their money in cash is because they may see the investment as an alternative to cash in the hope that it offers higher returns. And as we said earlier, if the pension scheme is buying an asset from your business or from you, the pension scheme will have to write a cheque to you for the value of that asset. But there are sometimes investment proposals that are put to us, and if we can't understand it, and we can't understand the rationale behind it, we will we'll consider it, we'll conduct due diligence on it, not to say whether or not it's suitable for you as a client, because that would be advice, and we're not regulated to give you advice on suitability, but we'll look at it to see if it's going to be acceptable to us as an acceptable investment within one of our pension schemes. So if it doesn't stack up commercially, we may say, unfortunately, sorry, we won't allow you to make that investment through a Dentons pension, but I mean, there's other providers out there that do the same as us, and you'd be perfectly at liberty to speak to another provider to see if that provider will offer a facility for you to do that. But Dentons does conduct robust due diligence on any investment that's put to us, other than straightforward things like quoted stocks and shares. In terms of Dentons' permitted investment list, so we have a list of assets that we will allow within our SIP wrapper, and straightforward things like quoted stocks and shares on recognised stock exchanges, cash deposit accounts, term deposit accounts, current accounts are all perfectly possible. We will consider commercial property, as we've said. with our particular specialism in that. And potentially, if you're looking to join forces with other investors and invest through a property syndicate, we will look at that from a due diligence perspective. We'll also allow what's called investment grade gold bullion that meets various requirements for that. We'll allow unquoted shares, private limited company shares, to be bought through one of our schemes as well, but subject, again, to robust due diligence. And we will allow loans to UK companies. We won't allow loans to non-UK companies, but we'll allow these. But most of these subject to robust due diligence on Dentons' part. And we do have a list on our website, a permitted investment list. If you look on our website, you can see exactly what investments we will allow. And we also list there things that we won't allow. Some of the things we won't allow, incidentally, are things like cryptocurrency, carbon credits, litigation funding, various things that, in our experience, tend to cause problems if they're held within pension scheme wrappers. But that's not an exhaustive list, and if you've got a specific investment in mind, again, speak to Integrity 365 and they'll ask us. A SSAS is a different type of pension scheme. I said earlier that the close cousins, SIP and SSAS, are close cousins. The range of investments you can make is quite similar across both, but a SSAS has a particular distinction from SIPs in as much that a SSAS is allowed to lend money to a connected party, and that connected party being the company that has set up the SSAS in the first place for its members. So a SSAS is what's called an occupational pension scheme or a company-sponsored pension scheme, whereas a SIP is a personal pension. And it's that distinction that allows the SSAS trustees to lend money to the client's company. There are also, I won't go into the technical distinctions where you're looking to buy shares in your own company. There are restrictions that apply to SSASs that don't apply to SIPs, but there are other considerations that would probably rule out, from our perspective, you buying any shares in your own business through a Dentons, SIP or SSAS. The big difference between SIP and SSAS, though, is being able to lend money to the client's company, but there are very strict criteria that HMRC lay down here that must be adhered to. The maximum term of the loan is 5 years. It's got to be, the SSAS trustees have got to charge a commercial rate of interest to the borrower for having loaned money to it. Capital interest repayments at least annually, and it has to be repaid at equal capital interest repayments. The maximum loan that can be advanced to the client's company is 50% of the value of the scheme. And the big requirement is that the SSAS trustees must take a first legal charge over a suitable asset when they're lending money to the client's company. Now, there's various things that could be put up as security for that loan, ranging from commercial property through to shares in the company. Dentons' company policy on this, and it's only our company policy, you may find this varies from different provider to provider. Our company policy is that the loan security must take the form of bricks and mortar and or land, because unfortunately, if the borrower has declined and the business has failed, the chances of being able to recover all of that loan capital plus interest are reduced if, for example, the loan's been secured on shares in the company. Because if the company's failed, unfortunately, the shares are probably not going to be worth very much, if anything at all. And any money that can't be recovered by the SSAS trustees, loan capital plus interest, anything that's not recovered is unfortunately treated as an unauthorised payment to the borrower and subject to tax charges. But you may find different companies have different views on this. So those are really the main types of investment that we see through our SIP and SSAS schemes. Again, it will vary from provider to provider in terms of what you can and can't do within their schemes. But ultimately, the pension scheme is there to provide you, hopefully, with benefits in your lifetime. And that could be a tax-free lump sum and an ongoing income from the scheme. But if you are unfortunate enough to die whilst you have a pension scheme, one of the tax advantages that we heard of earlier is the fact that your beneficiaries, the people who you wanted to benefit in the event of your death, they can receive some or all of the money that's in the pension scheme in the event of your death. So we're going to look at that for a couple of minutes now, passing pension wealth on to your beneficiaries. Now, there are limitations. There's limitations on how much you can pay into a pension scheme in a tax relievable manner, as we said at the outset, but there are also limitations on how much you can effectively build up within your pension scheme in your lifetime and have paid out as a tax-free lump sum to your beneficiaries in the event of your death. So we've got two fairly new pieces of terminology that have only really been in effect or legal since the 6th of April this year. One is the lump sum and death benefit allowance, and the other one is the lump sum allowance. Now, the lump sum and death benefit allowance is set at £1,073,100, and that's the overall amount of money that you can accumulate within your pension scheme in your lifetime and pass on to your beneficiaries as a lump sum, tax-free if you die before age 75 in the event of your death. The lump sum allowance is the maximum amount of tax-free lump sum you can take in your lifetime. It's called pension commencement lump sum. Now, the maximum, unless you've got any forms of what are called lifetime allowance protections, the maximum lump sum that you can take in your lifetime is £268,275, but it's not as straightforward as that, because typically you can take 25% of your fund value as tax-free lump sum. So let's say your fund value was £100,000 at the time you started to take benefits. 25% of £100,000 is 25,000, and normally that's what you'd be able to take as a tax-free lump sum. And the balance of the pot, the £75,000 that's left over after your lump sum, can be used to provide you with an income for the rest of your life, or be passed on to your beneficiaries in the event of your death. Now, the rules around these allowances can be quite complex, and again, we would strongly urge you to speak to your advisor about your circumstances and how your benefits, your pension scheme interact with these new allowances that are in effect from the 6th of April 2024. Once you've taken a lump sum in your lifetime, that then reduces your overall lump sum and death benefit allowance by an equivalent amount. So let's say you've taken £25,000 as a tax-free lump sum. That would reduce, in your lifetime, that would reduce your lump sum and death benefit allowance by £25,000. And in our example here, if a client here had taken £268,275 as a tax-free lump sum in their lifetime, that would mean that their remaining lump sum and death benefit allowance, the amount they can pass on as a tax-free lump sum to their beneficiaries on death before age 75, it goes down to 804,825. So it's 268,275 being deducted from 1.0731 million. That's how these two new allowances interact with each other. And when you die, whether it's in a SIP or a SAS, hopefully you've completed what's called a death benefit nomination form, and that gives your pension provider an indication of who you would like to benefit in the event of your death, who you'd like the pension scheme money to pass on to. Now, you can nominate any number of beneficiaries you would like. Our example here, we've got the original SIP or SAS member has nominated 3 people to benefit in the event of their death, and then effectively inherit the pension wealth that's in the pension scheme. They're called nominees. And when those nominees have then inherited the pension pot, they then decide who they would like to benefit in the event of their death further down the line. Effectively, it's passing wealth down through the generations. So the nominees nominate their beneficiaries, and they're called successors. This terminology we got way back in 2015 when we got a set up. There's a lot of new, they're called pension freedoms, made it a lot easier to pass down wealth through the generations in a tax efficient manner than it had been previously. And we got this terminology, nominee and successor. So effectively, wealth can pass down through the generations in the pension scheme environment in a tax efficient and tax friendly way, particularly in relation to inheritance tax, because as we said earlier, typically pension scheme death benefits are not subject to inheritance tax because they don't normally form part of your estate. So it's one of the main tax benefits of having a registered pension scheme. Now, if there's an asset sitting in your pension scheme that's illiquid, for example, say commercial property or some unquoted private company shares, it may take some time to sell that asset to then pay out cash to the nominated beneficiaries. And we're going to look at liquidity, as I said, in a moment or two. But the tax consequences on your death before age 75, the tax consequences on your death through the pension scheme depend entirely on the date at which your age on which you die. If you die before your 75th birthday, when it comes to lump sums, they may be tax-free in the hands of your beneficiaries, but it does depend on where you sit within this lump sum and death benefit allowance figure that we looked at earlier. and it also depends on whether you've got any forms of protection against what used to be called the lifetime allowance, because that may give you, if you've got protections in place against the former lifetime allowance, you will have a higher lump sum and death benefit allowance than 1.0731 million. So lifetime allowance protections, if you have got the advantage of those, are still very important in this new environment that we're in from the 6th of April 24. So also, whether the amount can be paid out as a tax-free lump sum also depends if it's paid out within your overall lump sum and death benefit allowance, and also whether it's paid out within 2 years of your death. Because if it isn't paid out to your beneficiaries a lump sum within 2 years of your death, then they will suffer marginal rate tax, or they'll pay tax on receiving that lump sum from your pension scheme. And most providers, Dentons included, will try, and your advisors will try to ensure that benefits are paid out in lump sum form before the end of that 2-year period after your death, purely because it makes a big difference in terms of whether the beneficiaries pay tax on the payment of the lump sums or not. So that's death age pre-75, and the fund is paid out as a lump sum. We've got a testing against this new allowance that I mentioned earlier. If you die before age 75 and your beneficiaries are taking what's called drawdown pensions from your pension scheme, not a lump sum, they're taking drawdown pensions, and they can take it as little or as much as they like. It's just that if it's classed as beneficiary drawdown, it's classed as a pension income payment. Those are tax-free in the hands of your beneficiaries if you die before age 75, and they're not tested against any of these new allowances that we looked at earlier. So there's a very big difference. If you die before your 75th birthday, there can be a very big difference between whether the benefits are paid out as a lump sum or whether they're paid out under what's called beneficiary drawdown. And that's something absolutely, once again, speak to your advisor at Integrity 365 about, because that can all get quite, in fact, it is quite complex under the bonnet. Again, this is only if the benefits are paid out or if what's called designated to your beneficiaries within 2 years of your date of death. And if you've got an annuity and you die before your 75th birthday, those paid out tax-free to your beneficiaries if they're bought within 2 years of your death, once again. So death pre-age 75, the tax consequences can be very favourable to your beneficiaries, depending on if they're paid out as lump sum form and depending on whether or not you've got a fund value in excess of your available lump sum and death benefit allowance. Once you reach your 75th birthday, however, the tax consequences of death benefits changes quite dramatically, and lump sums, drawdowns, and drawdown pensions and annuities, when they're paid to your beneficiaries, are all paid. They all will have to pay tax at whatever their rate of tax is at that point in time. It's what's called the marginal rate of tax, and Integrity 365 can explain what that means to you in your circumstances. If, however, the money from the pension scheme is paid to a trust or to a registered charity or to your estate, the taxation consequences are different. The amounts of tax that are paid can be different. And again, Integrity can guide you on those. But age 75 is a big line in the sand when it comes to passing on pension wealth in a tax efficient manner. And the reason why age 75, it may seem like an arbitrary age to pin these things down to or draw a line in the sand. Age 75 is historically the age by which you have to what was called annuitise or buy an annuity with your accumulated fund. That requirement's just been carried forward into the new rules. No one ever has to buy an annuity anymore, typically, but we're still bound by age 75 as a very big line in the sand when it comes to the tax consequences of death benefits. Now, we said earlier that sometimes in a SIPP or a SAS, because of the nature of the types of investments that can take place there, sometimes there isn't liquidity to pay out benefits to the beneficiaries in cash form as quickly maybe as you'd like that to happen. If the desire is to sell, say for example, the commercial property or the unquoted shares, or turn the loan to the company into cash again, if the desire is to create cash very quickly, then you may have to wait a few months, if not longer, to actually turn that asset back into cash, but it's a possibility. For example, with commercial property sitting in a pension scheme, you have the choice in terms of when you want to sell that property. You may need never to sell it if it can be passed down through the generations, through this nominee and successor route that we mentioned earlier. So commercial property need never be sold, potentially, depending on your circumstances. But if you do want to sell it, it's entirely down to you as the scheme member when you want to sell that property, or if you want to sell that property. And that selling it obviously would create liquidity to pay out either tax-free lump sum in your lifetime, or to pay out benefits in cash form to your beneficiaries in line with the rules that we've just looked at. But if the taking benefits from pension schemes in our parlance within the industry is called decumulation. So when you're building up benefits through your working lifetime or your lifetime, we call that accumulation. When it comes to taking benefits out the other side through retirement or death benefits, we call it decumulation. Let's say you had a property in a SIP and it was owned, let's say we've got a situation here, we've got husband and wife, generation one, and they own a commercial property jointly through their SIP. If, for example, son and daughter, being generation two, want to buy that commercial property or take ownership of that commercial property from mum and dad's SIPs in their lifetime, their SIPs have got to have the cash to enable that property to be bought out from mum and dad's SIPs. So let's say the property is £150,000 in value. Between SIPs for son and daughter, they've got to have enough £150,000 plus a slush fund to enable that then to be that property to be bought from mum and dad's SIPs. And once that happens, it has to be done at a valuation again because the parties are connected with each other. Once that happens, then obviously it gives mum and dad SIPs liquid cash, and they can use that to take their retirement benefits in their lifetime. Alternatively, if that property is held in SIPs for mum and dad and they die, it could be passed down effectively to son and daughter in our example here through this beneficiary drawdown route that we mentioned earlier. So effectively the property is being passed down from one generation to the next in a pension scheme environment, typically inheritance tax free. Whether or not it's subject to income tax, it depends on circumstances, as we looked at earlier, pre or post 75, and whether or not you're above your lump sum and death benefit allowance. But there are ways and means of dealing with illiquid assets like bricks and mortar in a pension scheme. If, however, it suits your circumstances and the provider will allow it, the bricks and mortar that is owned by the pension scheme could actually be paid out to your beneficiaries as what's called a non-cash benefit, or in industry parlance, it's called an in specie benefit payment. So the property isn't sold, it's just re-registered from the pension scheme's legal ownership across into the beneficiary's ownership, or in your lifetime, you as an individual. That doesn't happen very commonly across our client bank and SIP or SSAS, but it's a possibility, but it does vary from provider to provider, and it can deal with a liquidity problem in the scheme if one does exist. And the only reason I'm really making this point is because by their very nature, SIP and SSAS can hold investments that may be deemed to be illiquid, as we looked at earlier. So that's a bit of a whistle-stop tour through some of the advantages of pension schemes in the first place, some of the types of investment you can make, how potentially you pass on wealth to your beneficiaries in the event of your death. Hopefully that's been of interest to you, and just invite Nicola to come back in here and find if we've got any questions that have come through. Nicola?
Thank you so much, Steve. That's been really useful to go through and some really interesting takeaways for our clients. So I'll open up the webinar up now to any questions. We've got a Q&A function and also a chat function there, so that will allow you to put through your questions to myself and to Steve. We do have, well, I'll give it a minute or so for those. We have had one or two come through already, but yeah, while we're waiting there, just to make you aware, we do have other webinars hosted by Integrity 365. So you've got those on our YouTube channel, via our website, and also some podcasts on Spotify too, including a previous webinar that Dentons was very helpful in hosting with us not too long ago. Okay, so I'll bring up some of the first questions we received. Let's have a look. It's very timely. Thought this one might come through. Following the election results, are there any pension changes that may impact my planning? I might take this one for you, Steve.
Yeah.
Give you a break. So tricky question. The truth is, nothing is known for sure at the moment. So Chancellor Rachel Reeves has ruled out a budget before September. We know in their Labour manifesto they have noted that they wish to review the pensions landscape. And they have nodded to the fact that that needs to be improved in terms of pension outcomes, and also to try and increase some investment into UK markets. What that actually looks like in real life, I'm not sure yet. No one knows. So I would I would say, your advisor will be in contact with you when things become clearer. And for now, we can only work with what we know. What they have confirmed is the state pension. They wish to maintain the triple lock. So that's good. And also, before winning the election, they did also maintain that they wish to not bring back the lifetime allowance charge that I know, Steve, you mentioned before. If you don't mind, actually, could you minimize those slides for me, Steve? Is that okay?
Yeah, so shall I stop sharing the screen? Yeah,
yeah, that'd be great. Thank you. So that is the bit we do know there. Another question come through. Can I pay into a pension for my child? So yes, you can. Probably a bit more limited than for adults, but whether it be a SIP or other pension, but let's use SIP for this example, you could put 3,600 gross into a pension for a child. So that's £2,880 net, and that's effectively the amount that you are allowed to contribute into a pension, without earnings. If you were to put more in than that, you would effectively need some sort of income to receive tax relief against. But effectively, yes, from day one, you can start a pension. One thing I would note on that, of course, is it does vary on minimums. So some providers will have higher minimum contribution levels than others. Again, that's something that one of your advisors can talk you through. Okay, one for you, Steve. So another question we've got here is, can I transfer a commercial property from my current pension provider to a new one without having to sell it and repurchase it? And are there any tax consequences from doing so?
Yeah, good question. And yes, that does come up quite often. It is possible if you own commercial property through a pension scheme currently, it is potentially possible to just have that lifted from the scheme it's in now and dropped into a new scheme or a different scheme. It's called an in-specie transfer because you're not selling it, it's just been lifted and dropped from one to the other. Thankfully, there's no stamp duty or land and building transaction tax if you're in Scotland. There's no stamp duty or LBTT for that because it's a pension scheme to pension scheme movement. There may be VAT implications potentially if the property doesn't have a tenant, but what you may find is that the pension scheme that you want to transfer it into, it will conduct its own due diligence on whether or not it's prepared to accept that property into its scheme, because effectively the legal owner of that asset will be, if it's SIP to SIP, the legal owner of that asset will be changing from SIP provider A, where it sits with currently, across to SIP provider B, and SIP provider B will just want to make sure that property is going to be acceptable to it. As we said earlier, I'm not commenting on suitability, just commenting on whether or not that asset is one that the provider is comfortable holding. And certainly Dentons, we're involved in quite a lot of these in-specie transfers from other providers across those.
Brilliant. Thank you very much. Well, I haven't got any more coming through, but if any more questions do come through, please feel free to contact one of your advisors, whether that's myself or one of my colleagues at Integrity 365. We'll be happy to help you there. And just thank you very much, Steve, for joining us today. I really appreciate your time. We will be emailing through a link to the webinar in a week or so. So if you did want to refer back to anything we've covered today, watch out for that. It will be shared. And thank you very much for today, and I hope you all have a lovely rest of your evening.
Thank you very much, Nicola.
Take care. Thank you.